Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. It's my pleasure to welcome the CEO of Value Research, Dhirendra Kumar. Dhiren, welcome.
Thank you, Rajesh.
You know, when we invest in a mutual fund and when they become very big, the question that comes to one's mind is, are they good investment as well?
The answer is yes and no.
Okay, let's go to the yes part first.
Yeah, the yes part is that, in many cases, mutual fund is a business of scale, and it has increasingly become beneficial for investors that bigger the better in many cases. There are some exceptions to it. Many small funds, many strategies are good only for being small. If they turn big, those strategies fail. When it comes to large cap funds or the ETFs or the debt funds, the liquid funds, bigger the better. You are able to de-risk yourself. You are able to, now SEBI has also provided that if a fund gets bigger, it is supposed to, it has to charge lower expense. So it is, you get the economies of scale. So in many cases, the large cap funds, the ETFs, the liquid funds, the ultra short term bond funds, bigger the better.
Bigger the better. Okay, what about the ideal size? The biggest one that I believe that's going on is 22,000 crore range, between 22 to 24,000 crore range. So does it matter, the size, the amount that is there?
It matters in some cases. When it comes to actively managed fund, getting very big means that the fund gets difficult for it to maneuver. But think of an index fund, an ETF, where it has to do nothing. It is in the business of replicating the index. Right. The popular index in India that we have are the ones which are investing in only large companies. Large companies, you have enough liquidity. In India, one fund has actually become a 51,000 crore fund, right. the Nifty ETF. But I don't think it is going to be a problem because, it can well be run. Because when you look at the underlying component, a fund is nothing but where it is supposed to be investing. And where it is supposed to invest, if they are not liquid enough, you are in trouble. You will end up buying something which will not be liquid, but you are supposed to be buying that necessarily. And when you want to sell, you will get stuck. That is not the case with the Nifty 50. There is no liquidity issue. But yes, it still has to be tested. Okay. Equity market in general, if you have very substantial sale, it has an impact. There is an impact cost. Prices do go down if a lot of people turn up to sell their investment, and that is the case with, at a certain level, demand, supply, or on a day-to-day basis has an impact. But I don't think, there is any problem of scale with the liquid fund. We have seen, 80,000 crore large, big liquid funds, and it was better, it was good, it was safer, it also had the economies, and it was also being run with great intensity, simply because the AMC had great skin in the business. It was so substantial that if it does poorly, it will have an impact on the business, howsoever low the expense be. So I would say that we still, most of our equity funds, even the actively managed funds, are far from achieving a scale where it becomes a deterrent to their performance. Index funds and those mechanical funds, I don't think there is any liquidity issue. What has happened recently, that is effective 1st of April, that they will start, some of these big funds, they will start getting the advantage of scale and passing it on to investors, because SEBI has clearly made a very differentiated expense advantage for the larger fund. In all other business, when you get big, you get the pricing power. Mutual fund has become a little different. When you get big, you are supposed to charge less. Yeah. Of course, on an aggregate, mutual fund companies will be making more money with their big funds. But the formula has been that up to 5,000 crore, X%, X minus some percent for the subsequent. So when you get very big, investors benefit. And that should translate into something very meaningful over a long period of time.
Okay. Vis-a-vis the free float market size of the Sensex, which is roughly about 39 lakh crore rupees, the large fund size, as you said, the biggest one going is 51,000. So the advantage in this scenario is that you get lower cost and liquidity.
Yeah, Indian mutual funds are very tiny right now. If you look at on an aggregate basis, stock ownership in India is nearly 51% promoters. The owners still own a good part of it. Then the FIIs, domestic institutions, mutual funds, they just account for about 8%. So they are far long way off. And then the market dynamics is changing. We still have a lot of businesses which are not in the public domain, a lot of businesses which are still not held by institutional investors, which is indirectly held by individuals. Mutual fund is one such vehicle, or insurance companies buying stocks. So we are far from there. I don't think mutual funds have hit a problem of scale yet.
Okay. So you've mentioned about the positive side. Yeah. What about the flip side of it?
There are strategies where getting big is your disadvantage. What in mutual fund context will be called as winner's curse. Okay. If a fund is supposed to be investing in small cap, small companies, mid-sized companies, or following a strategy which necessarily requires spotting some opportunity and waiting for it, and they turn blockbuster. Because all that we are talking about active management is beating the index, but somebody is working on absolute return strategy, then you have a problem. Running an open-end fund, what is called winner's curse. You do very well. And the moment you do very well, a lot of investors put money. And you were doing well because you were able to implement a strategy because you are small. You could do it on 100 crore, you could do it on a 300 crore corpus. When you turn 5,000 crore, that itself becomes your disadvantage. You can't maneuver now. You can't really, and even if you succeed, assuming that somebody was investing in smaller companies, and he was investing in smaller companies to the tune of 25 crore each position, and having 20 such position or 25 such position, and he succeeds with 10 of them. So this is a 500-600 crore fund. And because you have given superlative returns, extraordinary return, a lot of investors put money, and now you suddenly become 5,000 crore fund. Now you have to look for so many other opportunity. The underlying liquidity may not be there. So many strategies may not be replicable on a larger base. These strategies are, some of the thematic funds which funds launch, or the small caps and the mid caps. They will have a size barrier. Okay. When they turn big, worry about it.
Dhiren mentioned about the winner's curse, and what I also understand from this, Dhiren, is that funds become less agile.
Yes. Yeah. And for some strategies, it doesn't work. Yeah.
And also a drag on performances. Yes, yes. Correct? So if that is the case, what is the role of the fund manager then?
No, they have to act responsibly in a sense that...
They cannot stop people from investing.
So they can well stop. There has been instances where fund companies, they can. Because, if it is going to be... it's a matter of, building reputation. It is a matter of guarding the interest of the core investors. If a fund manager, but at the same time, it is disadvantageous for a business because you're in the business of, so there is a natural conflict that you get more money, you are able to earn more money. And the moment you say that you won't take more money, so you have to succeed and do well with what you have. So this is a natural conflict. And now SEBI has increasingly made it very difficult for fund companies to launch similar fund. Okay. You can say that, okay, I'm stopping the money, I won't take money here, but I'm launching a similar fund, and people can invest there. You can't do that.
Okay. What about the debt funds?
Debt funds, generally bigger the better. Here also you have the exceptions, that there are certain strategy, credit opportunity fund, which requires hard work.
The winners... curse will not
winner's curse do not apply. Okay. It applies only on a very small set of category of funds, but largely it does not apply. And here, bigger the better. And bigger the better on all counts. You have the economies, the fund company is interested, the fund manager is interested, and then you are able to de-risk yourself better. Think of, a fund is very large, say a 50,000 crore or 70,000 crore fund. And it has a lot of positions in many credits. Assuming the fund faces a calamity or faces a crisis, one is that your relative position in a security will be so less that it will not have a significant impact. The other is that the economies of scale, you will be able to deploy greater resources in ensuring that you will be relevant. In fact, in debt fund you get one more advantage which you typically don't get in equity market, because equity market is all electronic, all digital. In the debt market, it's an informal market, and somebody has to negotiate a deal for buying a security, and once you have the muscle, once you have large amount of money, you are able to get a finer pricing uh, to a great extent. So in by all counts, bigger the better. Some opportunity, the credit risk fund or some such thing, but those are the kind of fund which individual investors should keep away from anyway.
They also say that there's the ability to negotiate better terms with the issue of debt. A bit of elaboration on that?
Uh, think of a fund company which is going to buy 50 crore worth of a security, as compared to a person who calls up and says that I want 800 crore of this security yielding this much with this much maturity. Right. The guy will be working very hard to serve that 800 crore customer. Bigger the better. You are able to negotiate, and the brokerage or whatever the fulfillment cost will be far lower.
Okay. So, what would be your advice to the investor about the fund size? To me, you will say get into big.
No, I would say that don't worry about it as of now. Only to the extent your small and mid cap fund, worry about the size. The rest of them, you are far off from these funds achieving a scale where you have to worry. And let's see, our markets are fast changing. A larger scale of a larger mutual fund industry can actually solve most of the problem. Greater institutionalization of the market itself will be solved. So I don't think we are far from we are reaching a stage where we should worry about size for most of the funds. Small and mid cap funds, worry about it.
Okay. So what Dhiren is saying to you is don't alter your investment decisions based on the fund size. And secondly, what he's saying is just go by the performance track record of the fund. Right?
Yes.
Okay, we move on to the Q&A part of our program now. And our first question is from Ayush. And he says, is it fine to keep 100% equity allocation while investing for my retirement, which is 30 years away?
Yes, principally yes. But, market is a very weird place. You feel very optimistic about it. And when the going is good, you feel happy about it. But you can't be continually happy about investing in market. It gives you, all kind of, it's a roller coaster. It generally does well over a period of time. 5 years and more, you will be happy. You will not be disappointed. You generate more return than fixed income. You are able to beat inflation well. But in between, it will get you all those hiccups, it will give you all the shocks, surprises. And so that is why having some fixed income allocation helps. Even in a long-term portfolio, I would imagine that, a 10-20% allocation to fixed income, because you are following a plan. The other is that you get a rebalancing opportunity. Rebalancing opportunity means if you are 80% into equity, 20% into fixed income, and equity market tanks, then your 80% which was equity will become 60%. You will get an opportunity to move your money from fixed income to equity to reset the allocation. That way you will be buying cheap. The market has gone on, and when equity market does very well, assuming that you are we are in the middle of 2017 and market goes up by 50% in that year, and your 80% turns out to be 96% because it has gone up so much, while fixed income will go only by 8%. So what happens is you are able to realize a part of the gain. So but it requires discipline. If you want to keep it simple for 30 years and if you are not getting perturbed, 100% is fine. But if you are able to work on a asset allocation for yourself and stick to it and do not get finicky about it, do a rebalancing annually.
30 years is a long time.
It's a long time. Yeah. Still, one has to look at it, one has to imagine the worst case scenario. What happens? What will be your mind's, frame of mind if you started investing in 2007? And if you started investing in 2007 by way of SIP and you started investing 10,000 rupee, and by December 2007 you had invested 1,20,000 rupees, and that 1,20,000 rupee would have turned into something like 1,50,000 or 1,70,000 because that was a blockbuster year. And in another 5 months, in another 9 months, that money would have been reduced by 70% or 60%. You get worried. You have seen your money grow and fall so sharply. That is where that rebalancing, having that frame of, having the shock absorbers built into the design or the way you invest really comes in handy.
Okay. Our next question is from Sai Praveen, and he writes that what could be the threshold for assets under management of an aggressive hybrid fund?
Size is not a barrier here because they are not only go anywhere fund, they can actually have substantial fixed income. So 100 rupee in an aggressive hybrid fund, 35 rupee can be in fixed income, and that yields high yielding fixed income. 65% could be anywhere. It is not supposed to be small cap, large cap, mid. It's not supposed to be mid cap and small cap. So I would say that hybrid, the advantage of scale, it'll incur lower cost if it gets big. So big hybrid aggressive funds, I don't think it's a problem you should worry about it.
If you were to tell somebody, okay, take PPF or LSS, which one would you choose? Vasudevan wants that choice to be shown to him by you. Which is better according to him, PPF or ELSS?
No, by a wide margin, because PPF is nothing but a 15-year recurring deposit. So I would say that if you are looking to build something meaningful, then you should go for ELSS, because over any 15-year period, that kind of disciplined SIP will yield you, in PPF, 1,50,000, which is the maximum permissible investment, will turn into something like 40 lakh rupees in 15 years time, and all the returns that will be generated will also be tax free. As compared to that, an average performing ELSS over the last 15 years or 20 years or 25 years, in fact we have the oldest open-end fund which exists in the ELSS category is Magnum Tax Gain. It would have yielded something far more substantial because PPF yields 8.5%. Also, in tax efficiency and absolute safety is undoubtedly a very big charm of PPF. But the way mutual funds are getting democratized, and if you are able to do that, let me just give you an example in terms of what it would have been with the average, poor and an extraordinary ELSS over the last 15 years. The average ELSS would have become something like 80 lakh rupees. The poor performing ELSS would have been something like 65 lakh rupees. And the best performing ELSS, of course, best performing, spotting it is very hard. We have the benefit of hindsight, and after something has happened, it's far easier to spot it. But assuming that you got lucky, but it's a large fund, I'm talking of the best performing ELSS, which has existed for 15 years. There it would have become, 1 crore 40 lakh rupees. So think of it.
Vis-a-vis the PPF, which is mentioned, would have been
40 lakh rupees. So what I'm saying is that, if you are going to be disciplined investor as you will be in a PPF, you will be a big winner with ELSS.
Okay. So where
and of course, there's a taxability to it.
Okay.
Assuming that, you are able to, instead of 40 lakh rupees, you are able to make 80 lakh rupees and you'll be liable for taxes. Liable for taxes to the tune that, your investment of 1,50,000 rupee every year, which becomes, 15 lakh, and so you will have about 60 lakh rupees worth of gain. You will be liable for 6 lakh rupees of taxes on ELSS. But despite that,
40 में से 6 भी निकालो फिर. Roughly.
No.
From 60.
I'm talking of, the tax liability, which despite the tax liability, something which is yielding, you still gain substantially. But, this is all past. I'm hopeful that, even if the future is not going to be as rosy as the past, it will not be far different over a 10-15 years time period.
Okay. So, ELS is what, ELSS is what you need to go in for. A. Venkata writes that I am a senior citizen and my son transfers around rupees 40,000 every month to my bank account for the living expenses. What would be the tax implications for both of us?
No, because getting money from your son is not subject to gift tax. Your son will be liable for income tax on his earnings. What he does with the money on which he has paid taxes, and what he does with the money is not subject to taxes. And the gift tax laws are that if your money, if you gift among blood relations, son, daughter, spouses, it's not liable and it's not your income. It's a money which is coming from your son by way of gift, and your son is liable for taxes on his income which he would have incurred anyway.
Yes, okay. So Karangia's writes,
I'm happy to know that you have a son who is remitting you money every month.
Yeah, and taking care of his responsibility. So that means that if he were to pay, if he were paying, or I'm sure he is, the son paying money to his wife for the household chores or household expenses, plus he's paying to his father. So in both the cases.
Absolutely. I earn money and I'm liable for taxes on my earnings. What I do with my money is balance money. I gift it in a temple, I give it to my father, I give it to my wife, is not subject to taxes. If I give it to a stranger, then I'll have to report. Either I'm lending, which means the interest earned on that will be subject to taxes.
Okay.
If I'm actually gifting it to somebody, then it will be subject to gift tax.
Okay.
And the gift tax will be that person's liability who's getting the gift. And it has to be reported accordingly. But that is only in case of, and a stranger is defined as somebody who is not the first blood relation.
Okay. Karangia has written in saying that how do you compare an aggressive hybrid fund with a dynamic asset allocation fund? Which one is better?
I like aggressive hybrid funds simply because I like discipline.
Okay.
And I have great belief in the thing that it is hard to guess the market. And dynamic asset allocation funds try to do that. They try to invest more in equity when they think it is more. And some of them, the fund manager decides. In some funds, there is a model which decides, based on P ratio, some other variables, 10 other variables, or price to book value or something. So I don't trust those, but I greatly trust a defined allocation. Aggressive hybrid equity, they invest 65-70% into equity, remaining into fixed income. They do the rebalancing intensely, and that does the job. So if you are a long-term investor, at the same time, this category is suited for a conservative investor. Dynamic asset allocation funds have not been able to build a great case for themselves in the past.
Okay. Something like what you just answered is asked by Mr. Patel also. And he says, I'm 40 years of age and I have a horizon of 10 years for my investment. Which one should I go for, multi-cap fund or hybrid fund?
Depends, both will help you achieve reasonable return. But I would say that both are good vehicles for a 10-year time frame by way of SIP. But if you have never invested in the market, go with your hybrid fund. Go with the aggressive hybrid fund. If you have been used to, if for 2, 3 years, 4 years, if you have invested in the past, you have gotten used to the ups and downs of the market, then go with the multi-cap fund. Else, go with the hybrid fund if you're a first-time investor.
Okay. Siddheshwara writes, I've been investing in 4 ELSs to exhaust my ATC limit. I have recently taken a home loan, the principal repayment of which would be alone sufficient to exhaust the ATC limit. What should I do now?
You don't need to invest in ELSs to save taxes. But if you still have surplus, investing in equity for the long term is not going to hurt you. So the whole objective of investing is not to save taxes. If you can save and if you can invest in an equity fund. And you don't have to necessarily invest in an ELSS fund, invest in a multi-cap fund, invest in a hybrid fund, whatever. But and that will yield you better return. You will have something meaningful accumulating for you.
Okay. The next question is against what you've been teaching all along. Okay. Here is this question from Ayush. She says, I have invested in 22 mutual fund schemes over the past 2 to 3 years. I'm now confused, he has to be, whether to retain them or to consolidate them. What should I do?
Of course, he knows the answer. And, in fact, last week I received a mail that, after watching one of our Hangout session, in a very cynical way, the reader was actually writing that I'm a great collector of mutual fund. I have 43 of them. And he has actually heard our conversation, taken a lesson, and then he was able to list 5 funds in which he wanted to consolidate. He wanted a reaffirmation. I still have to reply to his
I think
mail.
you need to address Ayush particularly
So,
so
yes,
that he can
I'll
take
tell
a
you,
lesson from
first
this.
and foremost, yes, you should reduce it to 2-3 funds, and that will be good enough. Most financial objectives of investing for the long term in equity can be achieved with that. I'll tell you the disadvantage of investing in too many funds. You are paying the cost of actively managed funds, which is higher,
Right.
and by virtue of owning these 22 funds of varied kind, you are actually owner of an index fund. That's one. Too much diversification, too much of a good thing may not be a good thing, and that is what is happening. Second is the psychology. When you invest in 22 funds, you are a little bit interested in all of them, but not interested in any of them meaningfully. When you have 2 or 3 funds, you will worry about it. You will have some, and because when you have 22 funds, something goes down by 10%, you say, oh, it's a very tiny thing, it doesn't matter. And the reverse will also be true. Something exceptional happens to your fund, it will have a very minute, it will have a very meaningless impact on your overall performance. So interest, impact, and the too much of diversification. So you should consolidate into 2-3 funds. How to go about consolidating? Find the 3 best multi-cap funds of your own 22, and make sure that you are able to redeem rest of them and consolidate in them.
Okay. Well, that's all we have in today's program. Continue to invest, as we always say to you, and don't worry too much about the funds which become too big. Okay? As we said, performance is important. The track record is what you need to take care of. Till we meet next time, it's bye from Virendra and me, Rajesh.